What are business metrics? Well, really, it's something important for you to pay attention to for your business. Whether you're a new business or a business that's been established and thriving, it's really a way of looking at the information about your business to tell you, hey, what are you doing right? What are you doing wrong? Where do you want to improve? What things do you need to be doing to really monitor the financial and operational health of your business? The reason that you want to look at your business metrics is to first monitor your company's health, see how you're doing, what things are going right, what things are going wrong. Measure your progress over time. Really think about how things are improving over the course of time, and when after you develop those metrics to see when you need to make adjustments to your plan. What types of things do you need to tweak? What's not going well, and what do you need to maybe change to figure out what you need to do better. So metrics, business metrics and KPIs really just help you to figure out where things are going well, where things need to be improved. How you come up with your metrics, really, it's every business is different. And depending on the type of business, what the size of the business, whether you have employees or whether you're a one-man shop, every business is going to have different things that they need to look at. But there's a few themes that are common throughout business metrics and the KPIs that businesses should look at. And I always feel like you should look at it from three different perspectives. First is a bank or lending perspective. How is a banker going to be looking at your business? Because odds are most businesses are going to have to take out a loan to either buy a building or to fund additional growth, or for some reason they're going to want to look at what, talk to a bank and get a loan at some point. So considering what the bank sees as important is, a key consideration in developing those metrics. Now, a bank's going to look at different viewpoints. They're going to look at, they call it the 5 C's of credit. A banker looks at your character, capacity, capital, conditions, and collateral. And those are a lot of words, but character, are you a trustworthy person? Do you have a good FICO score? They're going to look at that, so that's something to monitor. Capacity. Can your business afford a loan? They're going to look at financial information and say, hey, can you pay back this money that they're going to loan you? Capital, what have you as the owner invested in that business? So that's another thing. If you haven't invested much in the business, the bank's probably not going to be willing to invest a lot along with you. Because the last thing a bank wants to do is lose money. And so you want to make sure that you're looking at it from the bank's perspective. The conditions. What are the conditions of your business? The economic environment, and are you in an industry that's really on the upswing that has a lot of business potential for the future? And so they're going to look at business conditions for your business. And finally, the collateral. The collateral is, hey, what do you have to help the bank be willing to give you a loan? If for some reason you default, is there going to be property that's put up, or your house that's put up? Are you going to sign a personal guarantee? So they're going to look at that collateral. So those are the things that a bank is going to look at as considerations for a loan, and you want to keep that in mind as you develop the metrics. Now, from the financial side, there's a couple of super important metrics from a financial perspective on the banking perspective. The bankers look at a couple of key financial ratios that are super important to them in giving you a loan. And it's called the debt service coverage ratio. It's a long word. It's really, and I'm going to give a couple of their financial terms that are kind of, that what the bank looks at. But typically it's your EBITDA over your debt service. Or really EBITDA, that's earnings before interest, taxes, depreciation, and amortization. That's kind of the bank's way of saying, how much cash is the business generating? So they look at the cash that the business generates over, compared to the loan payments that you're going to have to make. So they want to see that that your business is able to pay for that loan. So the bare minimum obviously is going to be a ratio of 1 to 1, and that shows that you can just pay out that loan. But more likely than not, they're going to want to see a ratio of 1.25 to 1.5 to 1, showing that you have 25% more cash being generated than what the loan needs to be paid, because they want there to be a little wiggle room or a margin for error in case the economy goes down or you have a hiccup in your business. They want to make sure that they get paid, so they want to have some cushion in there before they give you a loan. So again, I like to look at metrics from the banker's perspective. You want to make sure that you're keeping them happy. Another perspective to look at is from an investor's perspective. And say for example, you want to have an investor help you, come in and give you a cash infusion to help you expand in the future. Or say you want to sell the business someday. Many businesses do. So you want to look at it from the perspective of what an investor would come and look at in your business. And so really, they're going to look at a few things. They want to make sure that the business is generating cash. So they're going to look at that EBITDA figure, earnings, before your non-cash items like depreciation and amortization. So how much cash is the business raising? How much cash flow that you have? What are the gross margins of the business? Are you profitable? They're going to look at those types of things. They're going to look at whether you've got any significant assets in the business. Any particular expertise or intangible assets or hard assets, buildings, some minerals in the ground, gold, whatever those assets are. They're going to look at that, and you want to consider that. How an investor is going to look at your business. And finally, the third perspective is a business perspective, and that's really those indicators, those KPIs that are unique to your business that tell you about the health of your business. Some of those things might be the revenue and the revenue growth for your particular business. How much cash you've got and what you do that helps you to conserve cash. There's going to be some operating metrics. A lot of businesses look at, they call it DSO, Days Sales Outstanding, and that really refers to how fast you're collecting your receivables. You want your DSO to be really low. If you have terms of net 30, well, most businesses can't collect them in 30 days, but if you're collecting them in 40 days, where your customers are paying 10 days late, that's pretty good. So you want to monitor that. If it starts to go up, hey, you have a problem. You want to do something to counteract that. Get on the phone, call your customers and ask them why they're not paying, or offer them a discount if they will pay on time. Those types of things. Another operational metric that's common: if you have inventory, you'll look at inventory turns. How fast is that inventory being sold, and how much are you having to invest in that inventory before you get cash from the sale of it? And then so those are some common KPIs. Other operational metrics are really super specific to, depends on the business. For example, a cloud software-based company, they're going to look at churn rates or the cost of customer acquisition, those types of things. So really, it just depends on the business, but you'll want to come up with those metrics that are more operational and unique to your business. So anyway, that's it for now. Have a good day.